Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that is really popular in the market and they've recently experienced an uptick in their stock price, and that stock is Meta. And as we can see over the last year, Meta Platforms is up around 26% over the last year, while the rest of the market is up around 6%. So they're actually outperforming the market over the last 12 months. And so in this video, I'm going to look into some of the recent news that came out surrounding Meta. I'm going to look at their financial statements and then figure out the intrinsic value per share for Meta Platforms at the moment. And so right here in this article, it's titled Meta's Year of Efficiency is Working, but is all the good news already priced into the stock? And some of the key points I touch on here is that Meta has executed the first phase of cost reductions. The company's focused on operational efficiency at all costs, and Wall Street sees major upside potential, and they actually did their own intrinsic value analysis, which I'll point out at the end of this article. And so we can see right here, the first key point I highlighted is that during the global pandemic, there were a lot of different experiences that companies had. One of the main ones being that remote work became the default option. And so as a result, cybersecurity firms and cloud computing applications saw booming demand. Also, companies like Amazon and Meta saw a huge uptick in online advertising and shopping. And CEO Mark Zuckerberg declared in February that 2023 would be a year of efficiency. And he also pointed out that they were going to go back to their roots, which were advertising, and that their longer term investments in the metaverse were going to take a back seat for now. Right here, they point out that in the first quarter of 2023, Meta generated $28.6 billion in revenue, which represented a 3% increase year over year. But that being said, the company's cost of revenue increased 10% annually. It is important to note that a part of that cost of revenue was $1.1 billion in restructuring charges as a result of the company's layoffs, which is obviously only a one-time expense. But even with that taken into account, if you were to back those costs out, costs still rose faster than revenue in the first quarter of 2023. But with all that said, we can see right here, they point out some of the big Wall Street firms like Goldman Sachs, Citigroup, Deutsche Bank revisited their price targets. And so a lot of these financial institutions have named Meta a buy rating at the moment, and they believe Meta is currently undervalued. Currently, Meta is trading at around $245 per share. And so Goldman Sachs believes the intrinsic value of Meta stock is $300, implying a 28% upside from $233, which is what it was trading at when this article was made. Citigroup were more bullish. This bank as well, which I can't really pronounce, but they're more bullish, putting price targets of $315 and $320, implying a 30% upside. And we can also see Deutsche Bank had a price target of around $290, implying a 24% upside. So these big financial institutions obviously believe that Meta is undervalued at the moment, and that could be good news. So it'll be interesting to see where Meta Platforms goes from here. Another article I wanted to touch on pointed out some of the results of their heavy investments into artificial intelligence lately. This article is titled Meta Unveils AI Testing Playground to Help Advertisers Build Campaigns. And obviously, if you've ever run ads on Facebook, you know that that's what they're called, ad and marketing campaigns. And in particular, they point out that they're basically trying to use artificial intelligence to make the whole advertising process a lot easier for advertisers and entrepreneurs on Meta, or particularly on Facebook's platform. They point out that in New York, Meta unveiled an AI sandbox, which is like a testing playground for advertisers to use to try out their new AI-powered ad tools. In particular, they point out that they've been making hefty investments in the AI space, and they're trying to fight the slowing growth and cost transition as a result of their investments in the metaverse. Text generation generates several versions of advertisers' copy. Ad copy is like this when you see something underneath an ad that makes you click on it, the writing. And they're basically trying to use AI to make ad copy for the advertiser so the advertiser doesn't have to do it themselves. And they're also using similar technology that relies on text to create generated images that advertisers can use in the background of their material. they gave an example right here. So you'd basically be able to just type like New York City blurry or snowy landscape blurry, and it would give you the image. And then the AI would also create the ad copy for you at the bottom here that was relevant to the picture. So they're basically taking the human being out of the equation here and making it so that artificial intelligence can do all of this rudimentary work for you, which obviously make the process a lot more seamless. They point out right here, as I just said, you could say NYC street blurred or snow mountain blurred, abstract, high quality, and it would just automatically generate that background image for you, so you could remove the human being from that picture. They're also making it so that image outcropping would automatically happen and adapt images to the correct size for all of Meta's platforms like Facebook and Instagram, which if you've ever advertised on Facebook before, you know is a little bit annoying. So the fact that they're making artificial intelligence do this automatically would definitely make things a lot easier for advertisers. And they're saying that they're going to gradually expand their AI sandbox tools to more advertisers starting in July. Overall, they point out that the generative AI space is developing incredibly quickly right now, and it's a very exciting time, and their unique opportunity is to integrate these features over time into their products. So a lot of interesting stuff happening in the generative AI space right now, also with ChatGPT, and a lot of these big tech companies are trying to capitalize on that. And so they're moving really fast, and it's going to be interesting to see how this ends up playing out in terms of growing these companies and increasing profit margins. And so right here we can see their financial statements, starting out with their balance sheet. I'm going to look at this and their income statement and their cash flow statement. We can see they're comparing their balance sheet for December 31st and March 31st. Total assets are down from $185 billion to $184 billion. They have mostly stockholders' equity on their balance sheet of $124 billion compared to $59 billion of liabilities, and their retained earnings decreased slightly, probably as a result of, as the article pointed out, the fact that their cost of revenues increased a lot quicker than their revenues did, and as a result that ended up eating into their retained earnings. Then right here we can see on page 8 their income statement. Revenues increased from $27.9 billion to $28.6 billion year over year, so that's an increase of around 3%. And then net income decreased from $7.4 billion to $5.7 billion, so that's a decrease of around 24% year over year. So not very good earnings growth, but very good, or not very good revenue growth either, only at around 3%. And so right here, lastly, in their cash flow statement, we're comparing the first quarter of 2022 to 2023. Operating cash flow decreased from $14 billion to $13.9 billion, and then they repurchased around $9.3 billion of Class A common stock. So they are still prioritizing returning value back to shareholders. They spent $9 billion of their $13 billion in operating cash flow just buying back stock. So that is a good sign for current shareholders. Now we have a discounted cash flow model here to figure out the intrinsic value per share for Meta. Yahoo Finance is estimating that the company is going to grow at around 18.5% for the next 5 years. They had around $19 billion of free cash flow in 2022, $9 billion of net cash on their balance sheet after subtracting debt, and 2 billion shares outstanding. That puts their intrinsic value per share at $201 per share, which means that based on the estimates from Yahoo Finance, they are currently not trading below intrinsic value per share. They're trading at around $245 per share, which is definitely higher than 201. But as we saw from the article, those financial institutions obviously thought differently. So it really depends on the metrics that you're using to figure out the intrinsic value of the company you're analyzing. And then right here, I did a competitor analysis comparing them to the other big tech companies, Apple, Microsoft, Google, and Amazon. We can see Meta has the highest gross profit margin, one of the lowest net profit margins. Amazon isn't really profitable, so can't really look at their profit margins. They have the lowest return on assets and also like a middling of the pack PE ratio, and they're also one of the companies that does not pay a dividend. Apple and Microsoft do pay dividends, however. So from a profit margin perspective, if you were just looking at gross profit margin, Meta is doing the best. But across all the other boards, even though they're still pretty competitive, it looks like you'd probably want to give it to either Microsoft or Apple. And then lastly, I wanted to compare them to other companies we've looked at in past videos. Meta actually ended up making it onto the share price compared to intrinsic value chart here. They come in 6th place, trading at 121% of their estimated intrinsic value at the moment. And so that puts them in 6th place on the table. Google, ConocoPhillips, GE, and ExxonMobil are still the only companies we've looked at that are trading below intrinsic value per share. We can see right here, their estimated growth rate comes out to be around 18.5%, putting them at 6th place on the growth rate table. They had a 79% gross profit margin, putting them in 2nd place on the gross profit margin table behind Adobe's 89%, and a 19% net profit margin, which puts them in 9th place on the net profitability table. And then lastly, looking at their stock performance over the last 5 years, we can see they're only up around 30%, which isn't good enough to get them onto the table here. Tesla has a #1 spot at 781% over the last 5 years. So in terms of comparing them to the other companies we've looked at, it looks like Meta is doing pretty good. They're competitive on all of the tables except for stock performance. And then in terms of comparing them to the other companies in their industry, they have a competitive or a dominating gross profit margin, and then they're sort of competitive, middling of the pack in all of the other areas. So I'd be interested to know what you guys think of Meta. They've obviously made a pretty big turnaround here. At one point, they were trading at around $90 per share in November of 2022. And now, a few months later, they are up to $245 per share. So that is definitely a massive increase. It'll be interesting to see if they can continue this momentum. Let me know what you guys think in the comments below. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.